Retirement used to be simple. Work, save, and enjoy your golden years. But today, everything feels more complicated. The rules have changed and not in your favor. Let's break down what's different, what it means for you, and how you can still build the retirement you deserve. There was a time when pensions made retirement planning simple. You worked for a company, they promised you a lifetime paycheck in retirement, and you didn't have to think twice about it. It was predictable, reliable, and it worked. But for most people, those days are gone. In 1978, Congress passed the Revenue Act, which included a little notice provision called Section 401k. This allowed employees to defer compensation from bonuses or stock options, planting the seeds for a major shift in how Americans save for retirement. And by the early 1980s, companies saw the advantages of 401k plans. Unlike traditional pensions, which required employers to bear all the investment risk and guarantee specific benefits, 401k shifted the responsibility to employees. And over the next few decades, the landscape of retirement planning dramatically changed. In 1980, roughly 38% of private sector workers were covered by traditional pension plans, but by 2008, that number had dropped to just 20%, and it has continued to decline since then. This transition means that today the responsibility for retirement planning largely rests on your shoulders. And while 401ks are a powerful tool, they come with risks and decisions that can feel overwhelming. The reality is managing your own retirement comes with challenges. Mistakes like being overly conservative or too concentrated in specific investments can derail your plans. And even worse, if you don't have a strategy for managing your income in the first few years of retirement, you could be exposed to sequence of return risk. That's when poor market performance early in retirement forces you to withdraw money at the worst possible time, shrinking your portfolio much faster than expected. And these risks are real, but the good news is they're also avoidable with the right strategy. In fact, with proper planning, you can create your own version of a pension. Start by getting crystal clear on your goals. It's not just about total savings. It's about understanding exactly what you'll need to spend in the first, let's say, 5 years of retirement. Knowing this number is crucial because you can then allocate those funds to something like short-term, high-quality bonds. This reduces your exposure to sequence of return risk and gives you peace of mind knowing your spending for those early years is set aside. It allows you to ride out the inevitable ups and downs of the market without too much worry. Next, take a close look at your diversification. Many investors are overly concentrated in US stocks, especially large growth stocks, and that could be dangerous. Remember the lost decade from 2000 to 2009 when US stocks produced almost no returns. Global diversification, spreading your investments across different markets and regions, can help protect your portfolio from prolonged underperformance in any one area. It's one of the most effective ways to reduce risk and ensure long-term stability. And finally, stay disciplined. This is where so many people struggle. Markets will go up and down. That's just part of investing. But making emotional decisions like selling when the market drops is one of the quickest ways to derail your plan. The key is having a strategy and sticking to it even when things feel uncertain. Managing your 401k is part of planning for retirement nowadays, but it's only one piece of the puzzle. For many retirees, Social Security is a critical source of income, but here's the issue. What happens if that safety net isn't as secure as you think? For decades, Social Security was the bedrock of retirement income in the United States, but there's a growing question that's hard to ignore. How secure is Social Security? Established in 1935, it provided retirees with a reliable source of income to supplement their savings. In its early years, the system was well-funded, benefiting from a robust ratio of workers to beneficiaries. For instance, in 1950, there were about 16 workers contributing to the system for every one beneficiary. And this abundance of contributions ensured that the program was financially sound and could meet its obligations to retirees. But over time, demographic shifts have changed this balance, leading to growing concerns about the program's long-term stability. Today, the situation is markedly different. The ratio of workers to beneficiaries has declined significantly, with only about 2.7 workers per beneficiary in 2023, and it's projected to drop to 2.3 by 2035. This shift is due to longer life expectancies and lower birth rates, resulting in fewer workers supporting more retirees. And consequently, the Social Security Trust Fund is projected to be depleted by 2034. After that point, continuing taxes are expected to cover only about 76% of scheduled benefits. So what can you do to protect yourself from this uncertainty? Well, first, diversify your income sources. Instead of heavily relying on Social Security, think about how your other investments like 401k IRAs or taxable accounts can supplement your income. This creates more flexibility and reduces your dependency on any one source. Next, if you're still a few years from retirement, think carefully about when to claim your benefits. You probably know, but waiting until full retirement age or even delaying until age 70 can significantly increase your monthly payouts. And we've discussed extensively on this channel how to bridge that income gap with a well-crafted income plan. And while this may not work for everyone, it's worth considering, especially if you're in good health and expect to live a long life. Finally, you could factor a conservative Social Security estimate into your retirement plan. So for example, instead of planning for 100% of your projected benefits, you could use 75% to account for potential reductions. This way, if cuts do happen, you're prepared, and if they don't, you'll have some extra funds as a cushion. But the bottom line is this: while Social Security is unlikely to disappear entirely, its future is uncertain. And by taking steps to diversify your income plan conservatively, you can build a retirement strategy that isn't overly reliant on one source of income. And that kind of flexibility can make all the difference in the world maintaining your financial security. But Social Security isn't the only piece of the retirement puzzle facing new challenges. For years, retirees relied on bonds as a stable, dependable source of income. However, the landscape for bonds has shifted dramatically, and that has major implications for your portfolio. For decades, bonds have been a cornerstone of retirement portfolios, offering again, reliable source of income and stability, and historically they provided consistent returns, making them a favored choice for retirees seeking safety. As you'll see in the 1980s, the 10-year treasury yields were often above 10%, providing substantial income for bond investors. However, over the past several decades, we've witnessed a significant decline in interest rates, and by 2020, those same 10-year treasury yields have fallen below 1%, reaching historic lows. This prolonged decline in interest rates acted as a tailwind for bond prices, benefiting previous generations of retirees. But today the landscape has shifted. With interest rates at or near historic lows, the traditional benefits of bonds have somewhat diminished. The Federal Reserve's policies and economic factors have kept rates suppressed, leading to lower yields and consequently reduced income for bondholders. Additionally, the bond market faced significant challenges in recent years. For instance, in 2022, rapid interest rate hikes by the Fed led to substantial declines in bond prices. And this environment poses a dilemma for retirees who have traditionally relied upon bonds for income and stability. And the question now is, how can you adapt your bond strategy to navigate these challenges effectively? Now, one approach is to focus on high-quality short-term bonds. And these bonds are less sensitive to interest rate fluctuations, reducing the risk of significant price declines when rates do rise. And by prioritizing credit quality and shorter durations, you can help preserve capital while still generating some income. Another strategy is to employ a trend-following approach to bond investing. And this involves adjusting your bond holdings based on prevailing market trends, aiming to capitalize on upward movements and then mitigate losses during downturns. And for example, in 2022, a trend-following strategy helped bond portfolios navigate the challenges posed by those rising interest rates. Our friends and team of PhD quants at Alpha Architect helped design our bond strategy that incorporates trend following, which you can learn more about in their blog post on their website. So by staying flexible and proactive, you can better manage the risks associated with today's bond market. Regularly reviewing your bond allocation and being willing to adjust your strategy in response to changing market conditions can help you maintain the income and stability that bonds have traditionally provided. But managing your portfolio is only one piece of the equation. Retirement is lasting longer than ever, and with that comes another significant challenge, which is rising healthcare and long-term care costs. Now, thanks to advancements in medicine and technology, people are living longer than ever. In 1950, the average life expectancy in the United States was around 68 years, and by 2023, it had risen to roughly 79 years. Emerging technologies, including AI, are already transforming healthcare. AI is improving early disease detection, personalizing treatment plans, and even streamlining drug development. These innovations could enhance both the quality and length of our lives in the years to come. And while living longer is a remarkable achievement, it brings with it substantial financial challenges, particularly concerning healthcare and long-term care costs. As we age, the likelihood of requiring assistance with just normal daily stuff increases. The costs associated with these services are significant. And in 2023, the annual median cost for a private room in a nursing home in the US was roughly $117,000. Even in-home care can be costly, with median annual expenses of around $76,000. Not only that, but medical cost inflation continues to rise, with projections indicating an increase of 8% in 2025. So this trend suggests that healthcare expenses will consume an increasingly larger portion of retirees' budgets. So what can you do? Well, first, finding the right Medicare or health insurance plan can make all the difference. This is where a good Medicare and health insurance expert comes in. They can shop the market to find the best plan for your needs, often saving you money on premiums and out-of-pocket costs. And we often connect our clients with specialists who can ensure they have the right coverage while keeping costs low. But long-term care is one of the trickiest parts of retirement planning. You may never need it, but if you do, the costs can add up fast. One option is to transfer some of that risk to an insurance company with a long-term care policy. These policies can help cover costs like assisted living or home nursing care, but they're not cheap. Another option is to think about your home equity as kind of a backup plan. You could downsize, use a reverse mortgage, or tap into your home's value in other ways to help cover care costs. You could also carve out a portion of your investment portfolio specifically for long-term care. Having funds set aside for this purpose can give you the flexibility and ensures you're prepared if needs arise. Now, most of the time, the best strategy is usually a combination of all these approaches. For example, you might use insurance for part of the risk, rely on home equity for another part, and then reserve some of your portfolio for the rest. Together, these strategies can give you a well-rounded plan. But there's one final challenge that's crept into modern retirement planning, and it's not about rising costs or market shifts. It's about the way we interact with information and tools. Now, on the surface, tools we have today to manage money seem like massive improvements. We have instant access to news, real-time market data, and apps that let us trade with the click of a button, all for free. It feels like retirees have more control over their financial future than ever before, but here's the reality. These advancements, while convenient, can often do more harm than good, especially when it comes to long-term retirement success. Today's news cycle moves faster than ever. Social media, financial websites, and 24-hour news cycles bombard us with constant updates, creating a sense of urgency. And it's easy to feel like every headline requires immediate action, but this can lead to emotional decision-making, right? Reacting to short-term market movements or sensational headlines often results in poor investment decisions. And then there's the ease of trading. You see, decades ago, making a trade required a phone call to your broker, and you'd pay a hefty fee. And that friction slowed things down and forced people to think before making any changes. But now with free trading platforms, you can move your money around in seconds. And while that sounds like a good thing, it often encourages overtrading, which studies have shown can significantly hurt long-term performance. One study from Dalbar consistently shows that the average investor significantly underperforms the market because of frequent emotionally driven decisions. In fact, their 30th annual report, they found that in 2023, the average equity investor earned 5.5% less than the S&P 500. And it's not just stocks. The average fixed income investor earned about 2.6% less than the bond index. With how much more information we have nowadays and the ability for average everyday people to invest for their future at the click of a button for free, you would think it would lead to better investor outcomes, but the data shows it's almost exactly opposite. So it might be useful to take a page out of the book of those that have come before us. First, slow down. Not every headline or market movement requires a response. And secondarily, focus on the big picture. Retirement is a marathon, not a sprint. And day-to-day fluctuations in the market matter far less than how your portfolio performs over the next 10, 20, or 30 years. And finally, have a strategy that you can stick with. Having a disciplined approach to investing, one that's based on your retirement goals, can help you avoid emotional mistakes. If you have an advisor or a written plan, rely on those as your guide. The tools we have today can be powerful, but only when used in the right way. So retirement today comes with a lot of moving pieces, managing investments, planning for rising healthcare costs, and avoiding emotional mistakes. But it's not just about getting through retirement. It's about thriving and building a life you've worked so hard for. If you're wondering what life could look like at the next level of wealth, like retiring with $6 million, in this video, my business partner, Anthony, breaks down the freedoms, surprises, and tough decisions that come with that kind of money. He'll see you over in that video right now.